Right now, the stock market is trading at near record highs, and the valuations of these stocks are starting to look a little bit stretched. A lot of investors are asking the exact same question. Should we remain and stick with those growth stocks, or should we be exploring and looking into more value? In today's video, we're going to be breaking down the Vanguard Value ETF, or the VTV, and seeing if this fund is right for the environment that we're seeing with those growth stocks being so elevated. We'll cover how it works, what's inside that portfolio, what experts are saying, and most importantly, whether you should add this to your portfolio. Stick around, because by the end of this video, you'll have a clear view of what the VTV is and exactly how it could fit in your portfolio. So let's start with the big picture. When we start looking at the S&P 500, it is now trading around 27.6, the average price to earning ratio, which is way above the historic norms that we've seen. Translation: stocks are expensive right now. There is not much value. There are not many stocks that are kind of on sale. And if we think of Warren Buffett, value is what he was always looking for. Now, when the market gets this expensive, a lot of people do turn to the value, a strategy that gives them exposure to very solid blue chip companies without paying the sky high prices that we see right now of all of these tech companies. So that's exactly where the value of this ETF does come in. Instead of chasing those very high valued tech names, the value investor focuses on companies that have very strong fundamentals through an extended amount of time for a reasonable value. So that's exactly what this Vanguard Value ETF is designed to do. So let's hop over, take a look at it. And I want to break it down quite a bit and show you exactly kind of where the value comes in. Now, right off the bat, you will notice on the right side, the risk reward scale is a little bit lower. It is a little bit less risk. Also, the 30-day SCE's yield to 2.17, pretty good on return. So not only are you picking up some value with this ETF, you're also picking up a pretty decent dividend yield. And overall, looking at the performance, it's pretty solid. I mean, year-to-date performance, the 9.45. Now, also remember that this ETF is not super heavy valuated into all of those tech stocks just because they are so overvalued at this price. The inception date, always something to pay attention to. It has been around for 21 years, so we do have a pretty good rating in there. And then looking at the overall performance, so looking at month end, 3.49. So again, pretty good for a month. 3 month looking at 7.49. Year to date, again, almost 10%. But this is where it gets kind of interesting. When you look at your 3-year, 13.5%, that is awesome on a 3-year return. 5 years, and when we think of investing in general, 5 years plus is exactly what we are looking for. 13.98%. So doing incredibly well on the 5-year, returning almost 14%. And again, remember, this is not very heavy and really focused on those tech companies. This is looking for companies that it believes are completely undervalued. 10-year, 11.56. And then since inception, so 21 years, even thinking of the housing market that we've seen decline, looking at some of the recession, even looking at COVID, returning about 9%. Now, I know this is a little bit lower, and we'll look at it in just a minute in comparison to the VOO. But again, a lot of people are worried when it comes to something like the QQQ, when we look at the VOO, that the valuation for these ETFs are getting way, way, way too high. Now, of course, the beta is perfect on because it does track a specific index and an index that was designed to be tracked itself. Now, looking at the valuation, and again, SEC yield 2.17, but I want to get into what exactly does this hold in itself. Now, if you remember, a lot of the ETFs that we look at are very strong into this large cap growth. This is the opposite. This is looking at large cap, still using some of those same companies that are in that S&P 500, but you'll notice it is right into the value side, meaning they are undervalued for what they think they're worth. Number of stocks, 323. So it does have a pretty decent amount of stocks. And looking at the growth rate, so the growth rate here over the last 5 years, 12.5%, so doing pretty well. And you'll also notice the P/E ratio much, much lower than what we're seeing of the VOO. Return on equity for 14.7, so doing pretty well. And this is a moderate to aggressive, but this is where it kind of breaks it out. So when we look at two big sectors that are kind of underperforming right now, number one being financials. When we look at banks, financial institutions, they have been underperforming, and that is what is driving a lot of value into this ETF itself, which it is the exact same with industrial, 16.5. Healthcare coming in a little bit lower. And again, when we look at Warren Buffett, thinking of like a healthcare, doing a massive, massive investment into healthcare companies, these again have been underperforming. And the reason they've underperforming, and honestly, they've only been underperforming in relationship to tech stocks, where if you have tech stocks that are growing 10x, of course, the financial, the industrial, the healthcare are going to underperform because the tech stocks are absolutely just crushing it. But the thing is, the tech companies are not going to be crushing it, are not going to be running away with it forever. There are market ups and downs. When we start looking at a longer term return around 10 years, the value does come back with a lot of these ETFs. And then looking at the holding, again, financial institutions, JP Morgan Chase is the top holding 3.6%. And the other thing to think about this is looking at 350 different funds that we're holding within here. There are not in a really big percentage. When we start looking Berkshire Hathaway, Exxon, Walmart, Oracle, Johnson & Johnson, Home Depot, Bank of America, these are all super well-established large companies within the United States that are not going to be going anywhere anytime soon. And also looking at these, they're the staples. When you think of Walmart, when you think of Johnson & Johnson, Home Depot, they are the absolute staples within the United States, making this a very good value. And like we said earlier, distribution overall, we've seen a couple different distribution yields over there. But let's do a comparison when it comes to the actual S&P 500. And let's break this out and see exactly how this looks. So we're going to compare it to the VOO versus the value ETF. Again, thinking of the holdings, going to be a little bit of a different break in here. But looking at the holdings again, we're at 325 versus 506. So a little bit of a less diversification. But again, the value is looking at different companies than we see with the VOO and the way that it's broken out. So looking right here, the VOO 15.2, the VTV 7%. This is tech. This is exactly where the tech comes in. And looking back again at even the last year, you can see the value really not being there, underperforming kind of where tech is. And we've seen this for an extended amount of time, which we can see honestly right here in the returns. VTV 1 month 3.4, even outperforming the VOO. Then of course the VOO takes it on the 3 month, even looking at the year to date. Very close in the numbers there. The 1 year, the VOO tech absolutely crushing it. But then when we go back 5 years, looking at the 5 year 14.75 versus 14.01. So very, very close with those two over a 5 year turn. And if we see the VOO, if we see some of those tech companies that a lot of people are saying are completely overvalued, it is going to make a really big difference on how this pulls back or what it looks like when the pullback does occur. Now, cost expense ratio, very similar. We know Vanguard funds are super cheap when it comes to investing in there. And this is the difference when you look at the breakup, looking at the VOO, NVIDIA, Microsoft, Apple, Amazon, Meta, they make up a bulk. Those are the very, very largest companies that we have within the United States. And even looking at the percentages here, I mean, you're talking what, 30, 35, maybe even 40%, even in the top 10. That is huge. That is a massive, heavy weighted focus that we see with the VOO based on the amount of these companies. And honestly, looking at NVIDIA, Microsoft, Apple, they're going to continue to run. They're going to continue to grow. But there is going to be a point, again, this is the way to kind of protect the portfolio, where if we see some of these pullbacks from some of these tech stocks, we are going to see a lot more money move into financial, move a lot more into value, move a lot more into these companies that have been kind of underperforming or have just been around for literally generations, tens of even hundreds of years on some of these. And this is where, again, the big shift kind of goes out of electronic technology services into finance, into healthcare, into durables, into utilities, into energy. That is where the VOO does not have much of a staple, not much of a percentage in comparison to the value that we see within the VTV. And this might mean, again, when you start looking at kind of the comparison to it, doesn't mean moving a little bit just to be safe into the VTV. I know it is more of a defensive play like what we've seen with like an HD, even looking at a VYM that's more of a dividend yield, more of those blue chip companies. A lot of people are saying this might be the time to actually move over and take out and looking at some of those higher value, kind of lower volatility within there. So when we start looking at, again, the beta, that very hard to beat when it comes to the expense ratio, that 0.04. So why should we really consider the VTV? Now, of course, great for investors that are talking about the stock market being overvalued, the growth stocks really being out of touch with the earnings that they're seeing in there. Also, if you're looking to diversify the portfolio, if you want to have a little bit more of a defensive tilt. Now, I'm not saying by any means putting everything into something like this. I'm saying maybe you put 5, 10, 15% of a portfolio into something like this, it is a very good option for people who want a little bit of risk mitigation, looking at dividends, also long-term potential growth like we've seen over the last 5 years. If you own the S&P 500, if you own that index fund, the VTV can be a very smart, very aligned complement to it, because when it is an overvalued market where we could see a pullback, it's going to make a big difference holding something like this. Now, of course, when it comes to investing, there is no perfect investment. If there is a tech boom, if we see tech continue to run, it is going to lag. It always does, because again, it is looking in these in these stocks that are really undervalued. So when we start looking at the index will not perform as high and as quickly as we see with some of these growth ETFs. So it is really good to have this as a diversification within a portfolio. By no means is it part and the only part of a strategy. So is this ETF good right now with the market moves? If you're worried about those higher valuations, you want that reliable dividend income, you like the low cost ETF investing, diversification into those undervalued companies like JP Morgan, the answer is yes. The VTV would make perfect sense going into a portfolio. But always make sure, guys, that it fits your financial goals. We always say this: when you look at your goals, your timeline, your risk tolerance, this is going to be you, and this is going to be you specifically. There is no perfect portfolio really for anyone, depending on what your risk tolerance is, exactly what your goals are. If you're 25 years old and you have a 40-year runway doing a lot more in growth, even with the ups and downs, would make a little bit more sense. But let's say you're 45, 55, and you don't want as much volatility in the market. This is an ETF that could absolutely make sense. So now I want to hear from you guys. Let me know, are you leaning more towards growth? Are we looking for value? Are you looking for a mix of both? Are we running both of these in a portfolio? Drop your answer down in the comment. And of course, if you found this video helpful, don't forget to like the video. Go ahead and subscribe to the channel. We have been growing like crazy for the Investing Insight, the personal finance, and share with anyone that might find value with ETF investing. So, all right, guys, like I said, leave that comment down below, and I'll catch you in the next video.